Good morning, good afternoon, good evening. Welcome to Frontier Dialogue number 7, hosted by Luohan Academy. Today's topic will combine two of the hottest words in the center of policy and business world, technology and equality. We will explore the relationship between technology and equality and discuss what role technology is or should be playing in shared prosperity. We're honored to have a distinguished panel of speakers joining us around the world. In the first session, our presenters and discussants will offer insights from macro policy, academic, and business perspectives. Every presenter will have 12 minutes. Every discussant will have 10 minutes. I will give you a verbal warning when there is only 1 minute left. In the second session, we'll hold open discussion before the concluding remarks from Professor Sargent. We also welcome the audience to participate with your questions and comments in the chat window or raise your hand directly. Because the first session is tightly timed for each speaker, I will only accommodate 1 to 2 clarifying questions after each discussant if time allows. We will use open discussion time in the second session for more in-depth discussion and comments from both panelists and participants. So without further ado, let's start the first panel of presentation. This panel is on macro and policy perspectives of equality issues. Our first speaker is Dr. Michael Spence. Dr. Spence is the William R. Berkeley Professor in Economics and Business at NYU Stern School and Professor and Dean Emeritus at Stanford Graduate School of Business. In addition to winning the Nobel Prize of Economics for Analysis of Markets with Asymmetric Information, Dr. Spence has been actively exploring economic growth, pandemic recovery, and many important topics. Today, Dr. Spence will give us opening remarks on causes, consequences, and solutions of equality issues in the digital era. Dr. Spence?
Let me see, am I unmuted? Thank you, Ginger. And thank you to Luohan Academy for allowing me to talk. So I'm going to start my stopwatch so I shut myself off before you do. Long asked me to talk a little bit about this subject from a global point of view. And so let me try to do that. I want to start, however, by sharing a perspective that I have that some of you may not agree with. Trends in inequality, both positive and negative, have been and are influenced by many things. Technology breakthroughs, including the cascade of digital ones we're now experiencing, structural transformations associated with growth and development, economic and social policies of a variety of kinds, including especially tax and investment in human capital, institutional arrangements and laws, and beneath all that, of course, social norms. So in the end, the conclusion I draw from this is that inequality is not really just a technological issue, it's a constrained social choice. And the broader subject is, from my point of view, political economy. Let me turn to sort of long-term patterns as a kind of preliminary to the discussion where we dive in deeply on a number of aspects of this. Globally, inequality has been falling pretty steadily in the entire post-war period. This is the result of a phenomenon that I and others call convergence. And it represents a sharp break from the previous 200 years before World War II, where the developing countries in this more recent period started to grow, initially somewhat slowly, but steadily and eventually more quickly than the advanced countries. None of this is surprising economically to those who study it, but basically they do this by importing and adapting technology, and now digital technology, and then increasingly developing their own and also by leveraging the accessible demand in an increasingly open, until recently, global economy. And that produces high potential productivity growth in the tradable sector that spills over into the rest of the economy, creating resources that are then invested in tangible and intangible assets that allow the domestic sectors to become additional powerful growth and employment engines. This global convergence trend is still working, but I want to flag an issue I'll come back to in a minute, which is there are now serious questions about whether the current collection of low-income countries, with more than 1 billion people in them, will actually somehow get trapped and not be participants in this convergence process. If we turn now to within country inequality patterns, within the developing countries, by almost all standard measures of inequality, inequality declined or equality increased for roughly 30 years after World War II. And then that pattern reversed very substantially, actually. And so inequality has been rising since then. There is considerable variation across countries in levels and rates of change in these measures. And that reflects, again, differences in social choices and responses to the underlying technological and market pressures. Contributing to this pattern of rising inequality was globalization at scale, particularly in the last few decades. That's probably run its course. Labor saving and skill bias technological advancement and digital technologies are factors in both of those things and increasingly major players in both. Within the low-income developing countries, think of them as late or slow starters in the growth and development process. Labor-intensive manufacturing as a source of comparative advantage is losing its power as an employment engine. And this is because of the breakthroughs in artificial intelligence and advanced robotics that I'm sure we'll hear more about. As the share of labor cost declines, labor costs become increasingly less decisive with respect to location. And so at this point, it's not clear what's going to replace it. The development economists like Danny Roderick think of this as a very major question confronting growth and development strategy. Within the emerging economies, think of these as middle and high middle income countries where most of the world's population now lives. Inequality levels and trends vary really quite widely. There is a tendency for growth and development processes to produce widening inequality, as we know from the work of Kuznets and Sir W. Arthur Lewis, at least for a while. And that is true even if everybody is gaining, albeit at different rates. This is generally regarded, at least in high growth countries, as a relatively benign form of inequality, provided it doesn't get too extreme. That said, that's only one dimension. Digital technology has and will play a powerful role in making growth patterns inclusive. The Luohan Academy's first major study documented this for China, but you can see the same things going on in India and increasingly in a wide range of middle income countries. These are countries that have left the labor intensive sectors behind, either by exporting them to lower income countries or by making them digitally capital intensive, thanks again to AI and advanced robotics. One thing I think it's worth noting and is not well studied yet is there has been an explosion of entrepreneurial activity globally, especially among digital and internet companies. You'll find unicorns growing almost like weeds on a global basis. It's true, the significant batches of them are in the United States, China, and Europe, but the remainder are growing very quickly. I attribute this to talent, low entry barriers associated with digital platforms and digital ecosystems, low capital requirements, platform-centered ecosystems, and an interesting development, which is a kind of global expansion of the entire supportive constructs of ecosystem constructs, including financing that enable this development. So I view this very positively. Let me turn now to digital transformations briefly. There are many dimensions of these transformations, and much of the discussion, at least in the developed world, is conducted through the lens of work and employment and skills. And that's important, but there are other dimensions, such as access to markets and services, that are important. So we actually have automation not only in things that directly relate to jobs, but we have automation in the creation of markets, in expanding access to them, in improving their efficiency, in closing informational gaps that have an exclusionary effect for subsets of the population, frequently poor or low access subsets of the population. And this pattern, which I think is really important, goes well beyond the economy narrowly defined to things like health, the delivery of primary care to low access populations, and to education. A third lens for thinking about digital transformations has to do with big structural changes in the economy. I don't want to go into this, but a classic example that we're right in the middle of is traditional retail being adapting to and being disrupted by the digital technologies associated with e-commerce, and that of course accelerated dramatically in the pandemic. If I had time, I would talk a little bit about something I discovered, which is Marchetti's constant, but I won't. Maybe we can talk about it later. To me, terminology is important. So I want to talk because I find that words like, autonomy, automation, mechanization, and so on are used a little bit too interchangeably in some of the literature. So mechanization is old. We saw it in its most powerful form in the Industrial Revolution. And this was really mainly what we would now call machine augmentation. Machines dug trenches, but they didn't do it by themselves. Blue collar jobs were eliminated. It was disruptive. It did require the acquisition of new skills. All of those things are common to the current situation. But of course, after difficult transitions, it drove astonishing increases, these waves of technology and mechanization in productivity and incomes. But these machines were not autonomous, or to put it slightly flamboyantly, the only programmable computers in those days, in the pre-digital era, were people. Does this automatically produce rising measured inequality? The answer is not necessarily. It produces a rising inequality only if there's a positive correlation between the winners, the so-called winners, and the underlying income and wealth distributions. So the effect really depends on where the impacts land and how long they last. And I think that being able to distinguish between transitory effects as opposed to sort of things that might be very long-term or permanent is important. I put in my notes here, the concept of losers in these transitions is very much dependent on the time horizons. Loser is not a permanent condition. Now let me talk very briefly about the kind of modern digital transformation. Automation implies, at least to me, the ability of machines to act autonomously. And this is genuinely new and puts us in somewhat uncharted territory because it is a product of the digital technologies. It's new, not because it writes people out of the script, but it does it in a different way, in what we don't really know how to call it, but in the information processing, control, coordination, decision and transactions dimensions of the economy. We have mechanization and automation for the first time. Or put differently, through the lens of work, the white collar layer of the economy was largely devoid of machines in the pre-digital era. So I think of automation as one of the big opportunities and challenges. Digital machines replace human beings I'm going to talk about two versions of automation. It's just the way I think about it. It's probably more subtle ways to do it. Digital machines replace humans in automation one in what are called routine or codifiable tasks. This has been well studied. Sorry, Ginger?
I'm sorry, 1 minute warning.
Okay. This has been well studied by David Autor and its colleagues. It basically affects jobs that we know how to do, but we also know precisely how we do them, so we can code it. I think the main thing that's been discovered is that this kind of automation, which I call automation one, did affect predominantly middle-income jobs, and it's produced a pattern, again, well documented by David and others, of job and income polarization, at least on a transitional basis. And as an interesting aside, it didn't generate a lot of employment. Automation two is machine learning plus automation one. And this has produced a dramatic increase in the range of tasks and activities that can be automated because it includes sequences of tasks, some of which cannot be coded. And it also includes tasks that human beings can't do at all. And so we will, I think, almost surely see further rounds of automation and augmentation. And this will occur across the entire economy. Think of it as a collection of super powerful general purpose technologies. That said, we're not very far along, and certainly in terms of implementation. Data from MGI, McKinsey Global Institute, and others suggest that the penetration rates across sectors in the economy, pick any economy you want, vary just enormously widely. I was very struck, but there's lots of examples of these technologies, but the one that struck me was DeepMind. And its recent, announcements that it has developed algorithms and deep learning algorithms that are capable of reasonably accurately predicting the 3D structure of proteins from the amino acid sequence itself. And that, and I believe, just listening to the scientists, is an enormously powerful productivity increasing tool for biomedical science, and its applications to drugs and so on. So, so let me just conclude. Is this going to produce rising inequality? I think to me, it's too soon to tell. It's certainly not clear that this more powerful kind of automation in this layer of the economy will operate as the previous one did, disproportionately on middle income jobs, but we'll have to see. And I'll just finish with this. I think it's almost certain to produce a burst of productivity growth and reverse most of the recent trends we saw. It will show up well outside the bounds of conventional measures of economic performance in healthcare, biomedical science, the energy transition, in education, and in the inclusive growth pattern. So I'm pretty optimistic, especially for societies that invest heavily in human capital in parallel as fast as they can with the digital technologies. So thanks for listening to me.
Thank you, Dr. Spence. That's an excellent bird's eye view of the topic. Our second speaker is Dr. Erik Berglof. He's currently the chief economist of the Asian Infrastructure Investment Bank on leave from the London School of Economics. Previously, he was the inaugural director of LSE's Institute of Global Affairs and the chief economist of the European Bank for Reconstruction and Development. Today, he will bring us a unique policy perspective. Dr. Berglof.
Thank you very much, and thank you for inviting me. It's a hard act to follow. Mike managed to cram in a lot of information and very interesting analysis into his 12 minutes. So I'm going to come from almost the opposite perspective. I'm going to try to see what can we do about these inequalities, and I'm going to share a presentation, I hope, and see if it can come up. So I was given a topic, and the topic was the balance of fairness enhancing policies and efficiency enhancing policies in reducing inequality. So this is a topic that has the characteristics of many topics here in China. It's this somehow when things are translated from Chinese, and I had the pleasure now of learning Chinese, and the elegance that Chinese have in making these kind of titles in Chinese. When they come over into English, they somehow lose all that elegance. But I tried to summarize it in balancing fairness and efficiencies in reducing inequalities. And so that's, I'm going to try to talk about this balance. And one of the points I'm going to try to make is that very often efficiency and fairness are actually not contradictory, and that they are often actually very much in line and complement each other. So I'm going to approach it from the perspective of what I call a recovering academic. So I've spent most of my life as an academic, but I have had two episodes of trying to work in policy, and that's what I'm doing now. And I think it's from that experience that I'm going to try to think about that issue of fairness and efficiency. So and as you probably, or the one who was observant would have noticed, I changed inequality to inequalities, and this is one thing that anyone who works on inequality, particularly in practice, is that this, one inequality seldom comes alone. They often come with others, so wealth inequality comes with it, income inequality, access to health, and maybe education. And I think this is very important when we think about inequality, that we cannot address them in isolation. And also when we manage to get traction on one inequality, we actually may be able to move whole clusters of inequality. And I think that's for someone who is trying to think about this in the context, particularly of infrastructure and so on. This is a very important insight. The second lesson is something that I come to very much from my experience at the EBRD, which is that we talk a lot about equality of outcome, and we talk about equality of opportunity, and of course both matter a lot. But from my experience, that equality opportunity is much easier to get consensus around, and much easier to translate into something that you can sort of operationally address in an organization. And the way I think about it, or my own experience, was that I came to EBRD. I spent 9 years actually at EBRD, and from the very beginning, I had this ambition to try to make that organization much more concerned about inequality and distributional outcomes, and also gender equality, having seen how the transition process particularly in Eastern Europe had increasingly been plagued by issues around inequality, and how that was undermining the kind of legitimacy of the process. But it was very difficult to get support for these issues in the board, because there was the view that this would somehow undermining the focus of the organization, and making the mandate less precise. But what really changed things was when the bank was asked to go into Turkey, and then of course the Middle East and North Africa in the Arab Spring. That experience, and when we saw that 80% of women were outside the formal labor force, and that the fact that there was so much inequality of opportunity was such a profound impression, and that really carried the way and changed the whole way that the bank operated and saw the issue of inequality. And there were two sort of sets of arguments around equality of opportunity. There was one set that was around the efficiency argument, and there was one set that was around the sort of political economy, the need that people were not part of the political process, and they had been left out of a lot of the political changes that were happening. Both arguments are important, but what really made a difference in that case was the equality of opportunity as a waste of resources, and the fact that so many people did not have an opportunity to realize their potential for whatever reason, or their gender, where they were born, who their parents were, and all those things. That really carried the way, and that was transformed that organization from an institution that didn't care about equality to one that had now more than 50% of the projects have a measurable component of inequality, or of equality, of inclusion it's called, but it's really about equality of opportunity. So again, the efficiency argument is not the only reason why you should care about the equality of opportunity, but it's one that is much easier to measure. We have a lot of a very good way of measuring that, and that is something that is important. Inclusion, as I mentioned, is really a multidimensional concept. And it's of course both about inclusion in terms of outcome and opportunity, but perhaps even more so, and something that I find increasingly important, is the inclusion in political and social processes. And that, in order to move political change and transformational processes, that aspect is very important. I mentioned the sort of political economy argument, but that is important. But it's really about how people feel that they participate. And I think when we talk about the opportunities from digital technologies, this is going to be extremely important. I think that the participation and ownership is really what can affect the sense of fairness and willingness to accept maybe unavoidable or maybe in some cases even desirable inequalities of outcome and opportunity. So these are 5 lessons that I have as a recovering academic. So of course, when you introduce digital technologies into this, you open up new inequalities, and you may also reinforce existing ones. You know, you have geographic location, you have digital literacy varying a lot, particularly across developing countries. You have the carbon footprint that where you are in the value chain may be very different in terms of how you digital technology works, or your data center, or you are somewhere else. And exclusion also varies a lot across countries and within organizations. So the digital technology may not necessarily reduce technologies, but it also unleashes new opportunities. So digital infrastructure can be absolutely transformational. And what is very important, and we have seen in so many cases, that it's not path dependent. It allows you to leapfrog, and there are many examples. I'll come to them in a minute. You can invest in human capital to encourage that transformation. You can improve access to health education in a way that you didn't think was possible before. You can, and this is what I want to really emphasize, is to increase the sense of participation in social political processes in a way that you can really change societies. Give you 2 or 3 examples. We just, as AIIB, funded a satellite system in Indonesia. So those who know, Indonesia is the 4th largest country in terms of population in the world, 17,000 islands. This is a project that through a satellite brings broadband to 45 million new individual beneficiaries, to number of schools, to 47,000 local villages, to health centers. These investments can be truly transformational. This was a public partnership. This an initiative that's very familiar to the hosts of the Luohan Academy, the Taobao villages in China, cooperation between Alibaba and the World Bank, trying to use digital technologies to bridge the income gap between urban and rural villages, encouraging online vendors to use e-commerce to activate commerce in villages in China, starting in Zhejiang provinces. Now there are 5,000 villages across 25 provinces in China. Digital infrastructure, basic digital skills, these have really changed the households. So, and one example, here's another maybe trivial example, but still very influential example. And I think this shows also how, particularly in digital health, we can see a lot of improvements in terms of access. So this is 2/3 of medical students in Pakistan are females, and half of those are females graduates stop working after getting their getting their degrees, and through this initiative they can now serve many poor households through digital technology. This is a slide. Just I was going to say a little bit about the role of data. Data is incredibly changing the picture. Of course, data. People on this call has worked a lot on data, and the data changes everything as the public goods of data, how that can change the nature of development. But it requires regulation to ensure fairness and efficiency. We need to make sure that we protect the small people in this process, multilateral developments can help try to get the efficiency and fairness working in this. So equality opportunity is efficient. Strict equality of outcome probably not efficient, but fairness is still very important. Digital infrastructure can open new and reinforce old inequalities, but also unleash extraordinary new opportunities. Perhaps great, yeah. Thank you.
Erik, thank you so much for sharing your experience in policymaking and real-world practice. Our discussant is Professor Hanming Fang, who is the Joseph Cohen Term Professor of Economics at the University of Pennsylvania. He has done extensive research in applied micro, including discrimination and other topics. So Hanming, take it away.
Thank you very much, Ginger. I hope you can see the slide.
Yes.
Okay, so first of all, thank you very much for Professor Spence and Dr. Berglof for the excellent presentation. I appreciate very much Long for inviting me to be the discussant. I'm obviously not qualified to discuss on this topic, but I will try my best to do my job. But let me start out by saying that I cannot agree more with everything both speakers mentioned. In my presentation, I will basically first put together maybe a conceptual framework to think about how inequality emerge and how technology can affect the inequality. Okay, so I would think of the three basic sources of inequality: pre-market, market, and post-market. And pre-market, you can think about we are born into different families with different endowments, and our skills will be affected by opportunity to education and training, and ultimately we'll enter the market with pre-market with the skills, and these skills are financial resources, and these are factors in the labor market that will affect will fetch factor prices that will determine the income we receive. And the factor prices, of course, is going to be shaped very much by technology and globalization, as Professor Spence mentioned, right? So the factors include labor skills, both entrepreneurial and managerial skills, land and natural resources, capital. We mentioned labor enhancing capital, or labor substituting capital, as more and more AI autonomous machines are coming online. Of course, ideas and technology. All these factors, what will be the price of these factors will be affected by how big the market size could be, right? And the market size obviously is going to be affected by both technology and globalization. I will illustrate in the next picture. The internet, for example, really accelerated the size of the market an idea or product can reach. But more than that, right? It's also the availability of data allowed us to produce goods that are more personalized. That the market expanded not just because it can reach more people because of the internet, but also goods that are more personalized, that suits consumers' needs better, can be produced because of the available the data and the technology. And also, Professor Spence mentioned the financial market. Finance plays an important role in affecting the factor prices, the ability to finance and scale up the startups, all these ideas that can quickly turn into a big company. This requires financial development, and of course, the ability of the financial development is very much affected by technology and globalization, and I'll illustrate that a little later as well. And as I said, market determines factor prices. And the factor prices affected by the production technology that's prevailing in the market, as well as laws and regulations and so on that policymakers can obviously play an important role. And that market, generates some type of income distribution that we may or may not like, but there are post-market interventions that can change it, right? The post-market redistribution in the form of taxes and transfers, social insurance, safety net, and the charity. And then finally, we will observe for a given time horizon, we're thinking about a year or a decade, whatever, some distribution of income, consumption, health, leisure, and well-being. And this income distribution will through dynamics result in some wealth and income, wealth inequality, wealth distribution and wealth inequality. And then there are roles to play in terms of this wealth distribution will affect the pre-market inequality that we see here. This arrow kind of represents how family backgrounds affect pre-market endowment as well as skill investment opportunities. And this framework, I think, also kind of illustrates how, if we are concerned about, if we do not like the resulting distribution of income from the market, we can think about interventions in 3 places: the pre-market policies, right, to ensure, for example, education access, equalization of school quality, education finance to alleviate credit constraints as well. And here, I would say that technology can play an important role, right? So, for example, equalization of school quality can be made easier by technology, right? So the best teachers that were previously inaccessible by a student in rural area, their lectures can now be broadcasted or be even broadcasted live even and accessed by students living in remote areas. Similar with financing, right? So education financing is always a problem because human capital cannot be used as collateral. But with the development in technology, there are abilities to provide trust and use data as collateral to alleviate the credit constraints in education financing market, right? So ultimately, in the pre-market intervention, the goal is to equalize opportunities, and which, as Erik mentioned, right, is not necessary in contradiction with efficiency, because equality of opportunity in terms of education access will allow our society to tap the previously untapped talents, right? There are a lot of talents that were wasted because they did not have opportunity to develop the skills and contribute to the labor market, right? So that's one area, the pre-market intervention. In the market, of course, there is regulation and laws that can affect the factor prices. Here, I would emphasize that the important thing for the within market intervention is to enhance competition. And finally, the tax and transfer and the charity are always these policies that can post-market can alleviate inequalities. So let me just quickly go through, illustrate a few of the ideas, provide some details of that conceptual framework. This was a picture about the active internet users and mobile users, etc., in the world, right? In the digital era, these are all potential consumers of a killer product, right? That was unimaginable before the digital age. And as I mentioned, the market access is for companies, the big companies that emerged in the last 20 years, is really growing at a speed that was unheard of in the previous decades. As I mentioned, the technology also allows further market access by tapping consumers who in economics language, who previously would not have purchased a product because the product was not tailor-made for them. And data availability and personalized production become more prevalent as technology allows, and that allowed more consumers, not just raw numbers, as I show you this picture, more users can actually become real consumers because the product can suit their needs. And this is a measure of globalization, as summarized by the flows of goods and flows of money, flows of information, and flows of people across the country borders. And you can see that from 1990, the world has been more globalized despite the recent kind of protest or a downward a decline in globalization. But nonetheless, the world is more collected, more connected place than ever before. So globalization allowed the market and ideas and companies to scale up a lot faster, both because it involves flows of money, goods, information, and people. Okay. And last thing I want to say about technology, how technology may change the the market factor prices that ultimately determines the inequality, is that technology institutions jointly determine the architecture of trust. And we know that borrowing and lending, which is an important part of finance, and borrowing and buying and selling, which is an important part of marketing, both require trust, especially among strangers, right? So Mike's colleague Ron Sadarajan at NYU once said, if we look back at history, every time there's a big expansion of economic activity, it's generally induced by the creation of new forms of trust. And the human society did have an evolution of how trust is being built, right? So early human society relies on peer-to-peer trust. Family members, relatives, and people of the same ethnic group, and so on. The problem of it is that it has a relatively small radius. So economic activity typically is constrained by how far the trust can radiate. And some groups that are somehow scattered around the world, they actually specialize in commerce, in finance, precisely because they have a broader peer-to-peer trust network. And that peer-to-peer trust network, trust eventually is being replaced by institutional trust, right? Relying on the state or some other powerful central authority to pass laws and resolve disputes and enforce contracts. The problem of this institutional trust system is limited by the incompleteness of contracts. Not everything can be described in words in a contract and being enforced by the court. And at this stage, Alibaba, for example, is building something called intermediary trust. E-commerce platforms is an intermediary that provides trust to the buyers and sellers who do not know each other, who might have never met each other, and they nonetheless trust each other because of the intermediary. And before the pandemic, in March of 2019, Long organized a very nice conference in person in Hangzhou about digital governance. And I participated in that conference where I basically said that the biggest contribution of Alibaba to the Chinese economy is to build a trust system, to really build a new trust system and allow the commerce to expand. And of course, we are now talking about blockchains. And this is, of course, there's uncertainty, but the biggest potential blockchain is that we may have a completely new architecture for trust, in code we trust. If that were to be realized, we are going to be seeing much bigger expansions of commerce and affecting prices of factors, of course. So last minute, I would just mention that poverty reduction and inequality technology can both reduce poverty and at the same time increase inequality, because they are two very different statistics. And I'm going to skip that. And this was the Taobao Village study that Erik mentioned. On the left-hand side is the Vox China summary article about this study. I'm one of the co-founders of Vox China, so this is a little bit of shameless advertisement. I hope you'll pay attention to it. But at the same time, digital economy may increase inequality because digital platforms enjoy important networks, thick market externality. Large online retailers can negotiate better procurement prices, and they have more data about their customers that can allow them to have a competitive advantage relative to other competitors. So the policy remedy, I say, is not to ban data or platform, but to leveling the playing field between large platforms and small and medium enterprises by ensuring mutual access to data and the platform infrastructure, and to ensure that efficiency gains from e-commerce are broadly shared among vendors on the platform. I think competition policy will be an important tool in, at the same time, enjoy the efficiency gained from big platforms, but also broadly share the efficiency gains. This is the point I want to echo with Professor Spence. There will be inequality in whatever mechanism we organize our economy, and whether these natural distributions of inequality is acceptable or not is a collective decision, because large inequalities will have consequences that are both social, political, economic, and moral. And it's ultimately socially acceptable inequalities are a political outcome through protests, elections, reforms, and revolutions, or threats of a revolution. And finally, just let me end with this slide. We should think about pre-market policies market regulations, social safety net, right, interventions in the pre-market, market, and post-market. The goal is to ensure inequality is more transitory than permanent and to promote intergenerational mobility. So I'll stop here. Thank you.
Thank you, Hanming. Thank you for offering the conceptual framework, which is very useful to organize many threads of thoughts. I don't see any questions or comments in the chat window. Anybody have a burning question to ask Dr. Spence, Dr. Berglof, or Dr. Fang? Okay, in interest of time, I will move on to the next panel on academic findings on technology and inequality. In the meantime, if you have any questions or comments, feel free to put them in the chat window, even if we don't have time to address it right after the presentation. We'll be able to come back to it in the panel discussion. So our next speaker is Dr. Robert Townsend from MIT. He is the Elizabeth and James Kaling Professor of Economics at MIT. Not only is Dr. Townsend known for his theoretical work in general equilibrium and mechanism design, he has but also done extensive empirical research in developing countries. So today he will share his thoughts in digital financial innovation and shared prosperity in developing countries. Dr. Townsend?
Thank you very much. It's really great to have this opportunity to present some work and engage in discussion. I've already benefited from the previous speakers. So, clear my screen here. So the question is, how does increase in financial infrastructure affect inequality and shared prosperity? So I'm going to give a couple of answers to that direct question. An historical answer with regards to the spread of branches of banks, so-called brick and mortar banking, and a contemporary answer having to do with digital banking. So these results are based on a paper with G and Tang, a bit about the model. I will say also that this talk is quite specific, and I take the models quite seriously, which is not to say that they're not leaving things out, but I'm letting the model kind of engage in a dialogue. So the model will speak back in terms, in this case, of these policies. So in terms of this model, the period is Thailand 1986 to 2011. You can identify actual and potential branch locations, namely where banks are or eventually located their branches. So there's a lot of local markets to study, and banks in the model decide where to put their branches and when. So there's a spatial cost here, which is salient to access a branch, either for credit as firms borrow or for saving among household or firms saving up for the future. There's also a collateral constraint in the model. That distinction matters, and I'll come back to that. So what we do is to calibrate the model based on observed 1986 initial conditions, and then simulate and compare to what actually happened in the data. We're going to get very close to the data, so in some sense the model is validated, and then we can use it to run this digital banking experiment as a counterfactual, where we're going to drop those spatial access costs to zero. So the importance of this kind of work, not just from me, is you get lessons from the data and the model. And although I put it on this slide in the context of the first model, it's quite a general point as I go through the subsequent slides. You can identify the dynamics, the transition paths, the delays, the uneven effects across local markets. And then we come to this terminological and definitional issue of shared prosperity. Inequality, I would say, is not necessarily a bad metric, but it can be misunderstood if it's not put in the context of some people can be better off, but more unequal. So inequality goes up while shared prosperity is going up. And I will say that in this model, there's a lot of, quote, sharing that happens through substantial intergenerational flow of funds. So there is advice to policymakers here and in the subsequent slides, which is to be clear about these distinctions. In particular, financial access is not a panacea, and policymakers are going to have to build in some commitment against political pressure, if possible, or choose another path. And the model-based approach delineates those options. So the model is successful in the sense of generating cumulative growth of about 10% per year. That's attributable to 41% growth in labor and 24% growth in capital. The model is featuring occupation transitions, as is typical in developing economies, from farming to wage work or to setting up and expanding small and medium enterprise. So households and businesses accumulate wealth, they invest in their own business or save through these financial intermediary mechanisms. So through the lens of the model and in the data, we see this shaped income genie, and it has already been anticipated. This should not be regarded as a surprise. The Kuznets curve is well documented in many countries. Here it's working through the opening of branches for unbanked populations, which increases financial access. A relatively small number of talented entrepreneurs gain access to credit and more income, increasing inequality. There is a demand for labor by those firms, but it's gradual, and wages tend to rise later, not right away. There is eventually a shortage of workers and a significant wage takeoff. But as I said, it takes time for those firms to expand, and eventually the Gini index of inequality falls. So there are some unanticipated results from this first experiment or match with historical data. Namely, economy-wide wage goes down in the initial years. So if policymakers are looking at the data and see a drop in a wage, they may be quite alarmed. Now, there's an easy explanation in the model. Farmers are becoming workers to supply the labor for these expanding firms, but initially there's lots of labor and not so much demand. So the wage stays at or close to the wage of agriculture while workers make this transition. So observationally, it's just a composition effect. You're adding more low income, low wage workers into the labor force. There's a lot of spatial heterogeneity. The local wage takeoffs occur at different points in time and space. So there's going to be substantial cross-market income inequality among the workers. Large welfare gains do happen for workers, but the shared prosperity takes some time, and the orders of magnitude and so on are different. So it's a more nuanced picture. Now we introduce digital banking. We ask this question: what if, counterfactual, instead of the expansion of branches, way back in 1986, they had introduced digital technology, which lowers the spatial access cost to zero, but we're going to keep the collateral constraint. So we can decompose that experiment into two parts or two channels. One, household saving. There's paper currency in the model. So that replacing part or all of it with interest-bearing accounts for the saving side, while letting the branch expansion reduce the spatial access costs as before. So this eliminates currency from the household wealth portfolio, which had been held for consumption smoothing. That increases welfare. The second part, comparing the lowering of credit access costs immediately to zero in the initial year, while letting the branch expansion reduce the deposit costs slowly as in the baseline with the expansion of the banks. This removes the use of currency by entrepreneurs for self-financing of the capital that they wish to buy. Quantitatively, at the calibrated values, the credit effect is dominating the savings effect, but I hasten to add that there's complementarity in the sense that the funds for credit are coming from the savings side through the intermediation. So one cannot literally and would not want to do one side without the other. Now, the unanticipated results of the digital banking experiment, it does remove much of the regional heterogeneity. It lifts GDP and TFP, but the rise in those variables is slow. So there's still, despite lowering spatial access costs to zero, there's still underlying dynamics in the model. Surprisingly to us, the income Gini is actually higher almost right from the get-go and sharply increasing. It's, quote, worse relative to the expansion of historical expansion of branches. This is due to both the wage effect and the profit effect. The wage effect is similar to what I said before, namely, there's an increase in demand for labor by the firms, but they're not getting paid very much. It takes about 5 years for the wage to actually be higher than it was in the baseline historical experiment with the branches. Entrepreneurs eventually accumulate wealth and their demand eventually increases the wages. On the profit side, the profits of entrepreneurs increase dramatically with digital banking. This drives up, in fact, given their demand for credit, the interest rate significantly, so that only the productive entrepreneurs survive. So we have kind of a very large selection effect. The not so productive entrepreneurs quit their business because the interest rates are high, and in turn become workers or even go back to the farm. And over time, of course, entrepreneurs accumulate more and more wealth. Savings is higher and the interest rates decline, which reverse this effect. That model ignores something potentially quite important, which is risk and the role of constraints in insurance, and in turn related to intergenerational inequality. So in this paper with Dejaneer da Silva, we look at risk-taking over the life cycle. Again, we quote, validate the model. The model is one of risk-taking entrepreneurs who face substantial, but still limited insurance against idiosyncratic shocks.
1 minute.
The model successfully accounts for the idiosyncratic risk premia, inequality, and life cycle patterns of consumption and risk-taking in the data. We can conduct two distinct counterfactual reforms. And here I want to make the point that it's important to distinguish the various aspects of digital technologies and smart contracts. One reform reduces risk constraints due to better pooling among strangers on a platform, which leads to a reduction in the idiosyncratic risk premium and leads to an investment boom. The initial generation of entrepreneurs benefit from this better insurance, but future generations are actually worse off as a consequence of the reform. The second reform allows labor income from other members of the household to be committed to human capital as collateral on the distributed ledger, because you can book those future wage contracts and then lend against it. So this increase in borrowing impacts life cycle investment and inequality dynamics, and it does so differently than relaxing the physical collateral constraints. So hopefully the model is sort of making us more aware of these distinctions. And my final slide is there to review in a way, there are various obstacles and there's great variation across countries. And all these things matter for policy. So in this paper with Gabla, Norris, G, and Felice Unsal, we looked at multiple financing friction, financial access, collateral constraints, Fang, markups due to verification costs. Each of those separately can be addressed by different aspects of the digital technology. Lower physical access costs I talked about in the first model. Data, history, or information is a partial substitute for monitoring costs, would lower the spread, and finally lower collateral needed, as I just discussed in the risk life cycle context. So our conclusion in this paper is the most binding constraint varies across countries. It's different in different countries. And the type of constraint that's most binding is not obvious from the data. One needs to look at the data through the lens of the model. It's possible to get it wrong. Relaxing the collateral constraint may indeed raise GDP in one country, but it may not be effective in other countries, as financial inclusion turns out to be more constrained by spreads or higher access costs that were not evident, at least not initially. So this kind of research is very relevant for policy. It's not, quote unquote, just an academic exercise. We developed this model in conjunction with the IMF, and it was also used by the AIIB at the level of country desks and actually used in official IMF guidance. And policymakers seem to know that they couldn't have the apple pie, that there are trade-offs. So they were actually quite attracted by the model, allowing them to think through these kinds of trade-offs. So thank you.
Thank you, Dr. Townsend, for sharing your dynamic model of the financial sector and the lessons we learned from it. Our next speaker is Dr. David Autor from MIT. Dr. Autor is the Ford Professor of Economics at MIT and a co-director of the MIT Task Force on the Work of the Future. His work on technology change, globalization, and inequality, especially in labor market, have inspired many researchers and policymakers. So we're glad to have opportunity to hear his insights on where does the new work come from. Dr. Autor?
Thank you very much. It's an honor to be here. And I'm actually, let me actually put up my slides to begin with. Here we go. And here we go. And so my presentation is called the Shaping the Future Work. And actually this builds on comments both from Mike Spence and Erik Berglof. I think when we think about thinking about the future and anticipating the future, we often take a passive view of the future will occur and our role is to determine how we're going to respond to it. But I want to emphasize the point in this very brief remarks that actually we have a lot of agency in shaping the future that we're going to experience. And Erik Berglof also hinted at this in his remarks that new technologies open new possibilities. And not only do they open new possibilities, but the technologies themselves are things that we create and influence. So there's a grave concern that you all are well aware of, that automation is rendering human labor superfluous, forcefully articulated by Daniel Susskind in 2020. Machines will not do everything in the future, but they do more. And as they slowly but relentlessly take on more and more tasks, human beings will be forced to retreat to an ever-shrinking set of activities. This is not a lump of labor fallacy argument. This is a sophisticated argument. This is about comparative advantage. Vasily Leontief said roughly the same thing in 1983 when he said humans will be rendered to the position of horses in that they're no longer a competitive factor of supply for many tasks. Of course, we know that after 2 centuries of rapid automation, we're still hard at work. The employment ratio to population ratio in most advanced countries and many developing countries has been rising, mostly as women have moved out of unpaid, unremunerated, very restrictive labor in the household to market opportunities and skills. And so there are 3 reasons why there's still so many jobs. 2 of them I think are quite familiar, and I'll just say them aloud. One is, of course, insatiability. As we get wealthier, our consumption desires scale at a rate about 1.03 times the rate of increase of our incomes, and that creates a lot of demand and new employment. The second is complementarity. Automation doesn't, or technology doesn't simply replace us, it often makes us more effective at what we do, whether you're using a pneumatic nail gun to install a roof, or whether you're using a statistics package to do data analysis. Complementarity often takes our existing skills and magnifies their reach, and so increases our marginal productivity. For the third point, and the focus of my remarks today, is about new work, novel demands for human specialization and expertise that are brought about by changes in technology, but also other demographic and social changes that create new needs for our specialized skills or new skills that didn't previously exist. So in 1940, US employment was about 45 million workers. In 2018, if we look at employment in 2018 in job titles, and I'll define my terms in a minute, that existed in 1940, employment hadn't actually risen that much, risen by about 5 million workers. But we know the US labor force tripled in that time. So what are people doing? Well, about 2/3 of employment in 2018 is in detailed jobs that were not present, had not yet been invented in 1940. So let me kind of give you a very illustrative examples. So, what is new work? So here's an example of marketing research. So timeless tasks in marketing research, form hypotheses, propose analyses, stare at results, start again. Many tasks are now done by machines, estimating models, testing significance, generating tables and figures. Simultaneously, new work has been created in this occupation. So in 1980, the job applied statistician was entered into the US Census. In same year, director of marketing research and analysis. In 2018, data visualization developer. These are not just new titles, these involve new specializations, new skill sets that weren't demanded in prior decades. Or take another example, fitness training. So there are timeless tasks, grunting and sweating, the agony and the ecstasy, et cetera. There are tasks that are formerly done by workers, now done by machines, timekeeping, heart rate, pace, adjusting resistance and weights on equipment. There are also new jobs, sports psychologists, sports nutritionists, certified therapeutic recreation specialists, right? A lot of new specialization that requires scarce skills. Broadly, looking across the sweep of the last 80 years, I've now arranged all US occupations into 12 broad categories, roughly ordered from low paid to high paid. You can see that in 1940, that's the blue bars, about 40% of employment was just in two categories, farming and mining and in production. If you look in 2018, you'll see that actually the number of workers, not the share workers, the number of workers in farming and mining and in production has fallen despite the tripling of the size of the labor force. There's much more employment now in professional jobs, in managerial jobs, in sales jobs, clerical and administrative support jobs, and in personal service jobs. And in many cases, the red bar, most of that work is new work, work that was not present 8 decades earlier. So there are 4 points I'm going to make, and I'm going to run out of time. So let me just summarize my points. One is that technological innovations both augment and automate human labor. These are distinct processes. We can measure them and we can distinguish them empirically. It's not just technology. Demand forces also shape where new work appears. Negative trade shocks, for example, discourage new work creation. I don't mean new employment creation. I mean the introduction of new types of specialized work. Demographic pressures, conversely, can foster new work creation. Both these things can work in both directions. It matters, therefore, not just whether we innovate, but how and where we innovate. How do we augment or do we automate? Where? Which occupations are augmented? Which ones are automated? And finally, that implies that the future of work is a work in progress. The jobs we get depend in part on the investments that we make and the institutions that turn productivity into prosperity. I should say my collaborators on this work on the empirical part are Anna Solomons of Utrecht University and Brian Segmiller, who's a PhD student at the MIT Sloan School. So in the remaining 5.5 minutes, I will say something about how we measure new work, several hypotheses we test, and then a couple of conclusions we draw. So first, in terms of measuring. So how do we measure new work? We use historical census documents that basically when you fill in the US Census, or if you fill in the US Census, you have to write in your occupation. There's not a checkbox, a bubble list. You write in what you do. The Census Bureau then has to code those to standardized categories, of which there are between 300 and 600 per decade. The way it does this is it creates a phone book of things you might write in. There'll be 30 to 40,000 examples in each decade, and it uses those to classify. But when a new example start appearing the census hasn't seen before, it adds them to these volumes. And so these volumes capture the flow of new titles as they enter usage. So for example, in 1940, the job of automatic welding machine operator was added. In 1960, chemical textile chemists. In 1980, controllers of remotely piloted vehicles. In 2000, AI specialists. In 2018, pediatric vascular surgeons. So you might look at this and say, oh, I get it. New work is about using new technology, designing new technology, installing new technology, selling new technology, integrating new technology, or maintaining new technology. Now let me give you another set of examples. Also added to the census: acrobatic dancers in 1940, pageant directors in 1960, hypnotherapists in 1980, sommeliers in 2010, drama therapists in 2018. Many of these things do not have a technological component necessarily. They reflect rising incomes, changing tastes, changing demographics, that change the need for care, childcare or adult care. So broadly, new work is not just about new machines. It's often about new specialties involving things assisting others or entertaining others, serving others. And just so you know, you say, how do I know these titles are new? So these are the ones we pulled out of the census volume. Here I'm using the Google Ngram viewer that measures the frequency of words occurrences in the US, published US texts. And I'm looking at the ratio of occurrence of these new titles to existing titles. And you can see here are titles that were added in 1940. They have a P that we find in 1940, ones added in 1950, 60, 70, and so on. So you can see that their appearance in these census volumes corresponds reasonably well with their frequency of occurrence of usage in published US language texts. So we think we're capturing something real here. So we try in this work to measure augmentation and automation. By augmentation, I mean technologies that add value to worker tasks. How do we do that? Well, we again use these census volumes that describe these detailed titles, and we think of these as describing the outputs of occupations. So for example, an anesthesiologist assistant, or a audiometrist, or a orthopedic mechanic, or an optometric technologist. So we think of those as describing occupational outputs. And we're going to look for innovations that discuss those outputs. And we're going to think of those innovations as potentially augmenting the value, changing demand, or changing the set of activities that can be accomplished. We also want to look for automation innovations, things that substitute for worker tasks. The way we're going to define those is we're going to use the Dictionary of Occupational Titles that describes workers' task inputs into occupations. And we're going to look for innovations that claim to do what workers do, whether that is performing blood tests, or analyzing test results, or providing data for diagnosis, et cetera. So we're trying to distinguish those two things. I'll say in a sentence, what do? We actually use natural language processing. We take both these descriptions of occupational outputs, these descriptions of occupational inputs, and all US patents from 1930 to present. We turn them into word embeddings. We find overlaps, effectively using cosine similarity measures, and we get the count of highly cited patents that appear to augment an occupation and those that appear to automate an occupation. That's our basic approach. It's very, very hands-off. This is not cherry-picked. This is not tuned, and it's completely parallel for augmentation and automation. We show that in general, occupations that are exposed to automation are also exposed to augmentation. So here's automation, here's augmentation. So for example, assemblers of electrical equipment are exposed to a lot of both. Childcare workers aren't exposed to much of either. However, there's some occupations that appear to be being automated, not augmented: machinists, cabinet makers, elevator installers. Others that appear to get a lot of augmentation, like operations and systems research analysts or business and promotion agents. There's then three hypotheses that we test. And I realize Ginger's about to tell me I have 1 minute left. So I'm just going to tell you what they are, and I won't tell you how we test them. One is that augmentation technologies spur the creation of new job types. Where we see augmentation occurring, we see new job titles emerging. That's not true for automation technologies. Those do not predict the emergence of new job titles. Two, we show that demand shifts, not just technologies, spur and retard the creation of new job types. When you have an outward demand shift, for example, a demographic shift, not only does it create more jobs, it creates more specialized work. When the China trade shock causes a big decline in US manufacturing employment due to China's rising productivity, we see not only a decline in manufacturing workers, but a slowdown in the rate of new manufacturing specialization. And finally, this is not just about new job titles, but about aggregate changes in work. Where we see a lot of new titles emerging, we see employment growing, where there's augmentation. Where we see a lot of automation, we see employment contracting. So let me just skip all that and just say, well, what do we draw from that? Well, first key takeaway is the jobs we get depend on part on the investments we make. This figure shows you the changing shape of innovation as we move from kind of a machine age to a chemical age to finally to an information age, where more than 50% of all patents are in information and instruments and electricity and electronics. That changes the set of occupations exposed to innovation. And I'll just summarize, I'm out of time. It dramatically changes where new work appears. In the early post-war era, most new work for non-college workers was in middle-paid construction, transportation, production, and clerical. It's now mostly in low-paid personal services. Most new job titles emerging for high-skilled workers are increasingly specialized. We see this even during the pandemic, that we see augmentation technologies and innovations being directed at work from home, which will augment the productivity of high-skilled workers going forward. So now I'm going to summarize. New work is quantitatively important. More than 60% of 2018 employment is in job titles that didn't yet exist in 1940. Innovations predict where new jobs emerge. New titles emerge where innovation complements outputs. They do not emerge where innovation replaces inputs. Innovation is only part of the story. New work is driven by changing taste, wealth, demographics, globalization. Its emergence accelerates and decelerates in predictable ways. So the conclusion that I want to draw is that the work of the future is a work in progress. As I said, the majority of today's jobs have yet to be invented. We are inventing the work of the future right now. We shape what technologies, whether they augment, whether they automate, and whom. So we should, knowing that agency we have, we should invent a future that we would want our children to inherit. Thanks very much.
Thank you, Dr. Autor, for sharing the encouraging history of new job types generated by technology, demography, and trade patterns. Our discussant is Dr. Al Roth. Al Roth is the Craig and Susan McCall Professor of Economics at Stanford and Professor Emeritus at Harvard. Dr. Roth won the Nobel Prize in applying the theory of stable allocations and practice of market design. Let's welcome Dr. Roth to comment on the two presentations by Dr. Townsend and Dr. Autor.
Okay, thank you. Can you hear me? Am I audible? Yes. Okay, so both Professors Townsend and Autor consider transitions of finances and of the spatial access to finances and of the means of production in manufacturing and other kinds of technology. And both give us cause for optimism in the long term, that there'll be new jobs and increased welfare. And of course, welfare and inequality are separate issues. But in the long term, they are both pretty optimistic. But while they see large welfare gains as happening, they happen only eventually. And so mostly what I have in my discussion is questions. And for Professor Townsend, my question is going to be, what are the historical parallels from which we might learn about what to expect from things like internet availability of access to finance? And for Professor Autor, I'd like to hear more at some point, and I'll have some speculations about the transition. There are going to be lots of new jobs. 60% of the jobs he tells us about are new since 1940. But what happens to the people whose old jobs disappear? Not all of them are going to transition to pediatric vascular surgeons. So let's think a little bit about what might be some possibly illuminating transitions that we've gone through in the past. Okay, so when we think about the spatial access to finance that Professor Townsend talks about, maybe the big transition we've seen over the last more than a century on the spatial access to retail, to commerce, will have some lessons for us. I don't know what they are, but let me just think a bit about the transition we've seen in retail. And of course, now when we see Alibaba and Amazon, we're seeing a very modern part of that transition, but it starts very early. In the United States, in the 1800s, Sears, Roebuck, and Montgomery Ward invented mail order catalogs, and that allowed rural consumers all of a sudden to access all sorts of goods that were not available or were only available from monopoly general stores in their rural areas. So all of a sudden you could order clothing, for instance, by mail. And that changed the amount of household production of clothing that we did in the United States. And it changed women's work a lot. Production of clothing used to be a big part of the work of rural women. And in cities, there was a similar kind of transition. There was just yesterday, the October issue of AIIB Applied came out, and there's a paper by Professor Wei Yu, who's now at Peking University. It's called "The Economics of Speed: The Electrification of the Streetcar System and the Decline of Mom and Pop Stores in Boston from 1885 to 1905." So what Professor Yu is telling us about is that even in cities, there was some local monopoly power of local stores because it was hard to get to more distant stores. But when public transit became available, we saw a movement from small local stores to large downtown department stores. And of course, a later transition with the automobile, as it became common, was department stores were supplanted in many ways by suburban shopping malls where you could easily go and park. You could reach them without public transportation, and you could park your car and shop. And of course, those shopping malls are now being displaced in many respects by electronic commerce that's been accelerated during the COVID lockdowns. So we've seen big transition in spatial access to retail, and it's had good and bad effects. And the transition has sometimes seen the workers in smaller stores going to work maybe at less desirable jobs, like being warehouse workers for Amazon. But overall, the long-term aspects of the transition may come to resemble more what Professor Autor has told us about as new kinds of jobs get created. So let's think a little bit about other historical examples we have of big changes in production where new jobs have been created and we don't miss the old jobs, but where the transition was tough and that had impact on inequality. So think about the transition from agriculture to manufacturing. At 150 years ago, almost more than 40% of American workers were agriculture workers, and I think now that number is down to something like 2%. And we don't miss those jobs. To work outdoors in all weather is not so much fun. We prefer working indoors and air conditioning when it's hot out and a roof over our heads when it's raining. But the people who were displaced by the mechanization of agriculture didn't get those air-conditioned office jobs. Many of them became textile workers. They worked in sewing machines and looms in textile mills and in the East Coast, and they lived in tenements. They didn't live in the countryside anymore. It's not clear that their welfare was improved, although their grandchildren are doing much better in many ways and are more prosperous and live longer and are healthier than they were. And similarly, we saw a transition from manufacturing, heavy manufacturing in the United States. I lived in Pittsburgh in the 1980s, and the steel mills were closing up and down the Ohio River Valley. And if you were a middle-aged steel worker, you might never have gotten as good a job again. So having the mills closed was bad for you. But of course, if you're if you were the high school student child of a steelworker, you didn't go into the mills at that point, and maybe you did become a pediatric vascular surgeon. So I think that, you know, this is one of these things where we have good reason to be optimistic about the long term, but we can perhaps learn some lessons about managing the short term. So let me close on a subject not touched on by Professors Autor and Townsend that I'm interested in, which is health inequality and how it's affected by access to health in various ways. And think about access to COVID vaccines in the United States in particular. Now the main barriers to access are behavioral and political. But in the early days, they were often digital. That is, lots of people who wanted vaccines had trouble finding where they could get them and making appointments. And there were lots of stories of elderly people who had priority for vaccines, relying on their children and grandchildren to operate the web for them to make appointments. So removing spatial disparities doesn't necessarily give everyone equal access. There might be generational differences. And of course, the other big thing that's going on with digital access, and especially during the lockdown, is the growth of telehealth. And that has two different kinds of implications. One is for patients, and another is for doctors and how they do business. So I was very glad to hear about the doctor brides in Pakistan who are able to work better with telehealth, because similar transitions have taken place in American medicine. When I was young, it wasn't at all unusual for family physicians to make house calls, and if you were hospitalized, they would round in the morning at 6 a.m. to help wake you up and see if you were resting comfortably. But now, and that was a tough job for couples to have. For you didn't see in those days too many men and women married to each other who both had very active medical practices, because somebody had to be home to take the kids to school and to make breakfast and things like that. So medicine has transformed the job description of doctors. Now there are hospitalists. Your general practitioner, your primary care physician won't come to see you in the hospital necessarily, and there can be part-time work. There are practices that share patients in efficient ways. So it's changed. It's increased the ability of women to have high-powered medical careers. And I think telehealth, we're not quite in the situation of the doctor brides in Pakistan, but it's very likely that will continue and be improved with telehealth. It may also improve the healthcare to people in rural areas, just as the mail order catalogs improve their access to commerce. So, but there'll be transitions. There'll be kinds of medicine that it'll take a little while for us to learn how to deliver with telehealth, and some of those will have unequal outcomes for different populations of patients. So I'll stop there. Predicting the future is hard. Keynes in 1930 wrote the famous article, The Economic Possibilities for Our Grandchildren, in which he anticipated that 100 years in the future, so that's in the coming decade, that the basic problems of scarcity and supplying needs would have been solved, and one of our big problems would be how to handle all our leisure. That doesn't seem to have happened, I think, much in the way that Professor Autor describes. We've found other things to do. And we still haven't, of course, increased food security for everyone in the world, and all of those things that Keynes thought might perhaps be solved by now. But looking ahead is always difficult. But both of our speakers in this session are looking ahead optimistically, and so I'm encouraged to hear that.
Thank you, Dr. Ross, for highlighting the transition in light of technology and evolution in health inequality. So Dr. Townsend, Dr. Autor, do you want to briefly respond to Dr. Ross' question?
I would be delighted to. So let me say, optimism is probably an overstatement of my position. My position is one of agency, that we have opportunity, but that doesn't mean we won't screw it up. And we've had ample evidence that we can screw it up in the past, and so I think we could do it again. So my point is that it's not written, as they would say in Lawrence of Arabia, the movie. We can shape our path. I think we can learn a lot, as Professor Roth said, from prior transitions. The agriculture transition was a very successful one in many ways because it happened to coincide with the growth of mass production. And I think the historical evidence suggests that actually it worked relatively smoothly in a lot of places where agriculture was declining. It's exactly where people were moving into factory employment, not by accident. And so there was something to absorb the labor that was freed, in the famous words of trade economists. But that's not been true with manufacturing decline. Pittsburgh is an excellent example. And a lot of the research I've done with Gordon Hanson and David Dorn on the US adaptation to the China trade shock also shows how slow and sclerotic and unsuccessful these job transitions can be when they happen very fast. They're spurred by inward demand contractions in specialized sectors without an obvious alternative that's nearly as good. So there are always winners and losers. They're not the same people, as Professor Roth emphasized, and there's much reason to be concerned. This is definitely not an argument that the problem will solve itself. It's an argument that it's a problem we can solve or shape if we choose to concentrate on it and recognize that potential.
Thank you.
Let me unmute myself. So, Al, I really enjoyed those comments quite a bit. I guess to follow up a bit on what David is saying, I can't tell if it's tongue in cheek or not that we're optimistic. In some cases, a lot of people are benefiting, if not right away, then in the long run. But you know, I also had some caveats to that. I mean, if the wages are going up, then people running small businesses have to pay those wages, and they may be harmed in the long run. So we do a better job quantifying all those things in the papers. The other thing is like intergenerational. So that one experiment where we used digital technology to allow better capitalization of human capital, that actually harmed future generations. And the reason that's happening is because there's an interaction between the micro and the macro. So although alleviating a constraint seems to make a lot of sense, it also means that capital at both the individual and the aggregate level are going to expand. You start increasing the aggregate level of capital, you hit diminishing returns, which in turn, impacts future generations and so on. So it's not, one size, and you didn't say that. Actually, what you did say was you posed a question about historical parallels, and then you proceeded to give us various marvelous examples of things that we could surmise have happened. And I would just say, from a narrow perspective of my talk, there's all this buzz about the new technologies, smart contracts and blockchain and encryption. I think should be right up there front and center. But it's not like all of a sudden we've moved to those things. They have been coming all along. I mean, back in the Middle Ages, they were using cleverly designed tally sticks from willow trees that had to be matched for the borrower, for the then holder of the lender's claim to present to the borrower, and so on. So I do agree with you about the history. I think we're too prone to think, we've moved into this entirely new world. One of the books I read early on is Brauddel's, I think it was called The Wheels of Commerce, which were actually 3 very thick volumes. And it's just filled with interesting episodes of Europe and in the rest of the world that I do think, I agree with you, have lessons for us. So thanks for those comments.
Thank you, Dr. Townsend. Oh, I'm sorry. Yeah, thank you, Dr. Townsend. We're going to switch gear a little bit from academic findings to business practice. Our first presenter in this panel is Dr. Michael Schwarz, He's the Vice President and Chief Economist of Microsoft. Before joining Microsoft, Dr. Schwarz was the Chief Economist for Google Cloud, Chief Scientist for Waze, and Head of Economic Research Unit at Yahoo, and a faculty at Harvard Economics. So he will bring us Microsoft practice in narrowing the opportunity gap by leveraging digital technology. Mike?
Thank you. It's a pleasure to be here, and it's a pleasure to be a part of this community. And that brings me to the first observation about what we mean today by inequality. We know that inequality within most developing countries is increasing. We also know that the inequality on the globe overall is actually shrinking, primarily because of very rapid economic development in India, China, that is narrowing the gap between the wealthy economies, the wealthiest economies and economies of India and China, where a very large share of world's population lives. So when we think about inequality, when we think about those trends, let's say nobody's incomes actually change. Let's imagine for a second that everybody's income stayed the same, but the notion of communities changed because of technology that we are using that's enabling teleconferences, because of the technology that allows communication and remote work. So right now I'm speaking today from my home in Berkeley, California, and some of you are in China, and some of you are in New York City, and some of you may be in Europe, and we are thousands of miles away, but we are part of the same community, and very much so. I recognize faces. I'm happy to be here talking to you. So I am surely a member of this community, just as much, actually more so, than I'm a member of my neighborhood association. So then the question is, if we are now members of communities that are not limited even by nation-state boundaries, how should we think about relevant comparison group for ourselves? So what, even in the world where incomes didn't change, once we break the boundaries of communities, how do we feel about inequality? So I don't know the answer to this question. That's one of the problems that technology kind of throws in front of us, left, front, and center. So today we live in a relatively prosperous world. There are more people than ever. There is less hunger than ever. It's all great. But technology changes the way we live. It destroys some jobs, creates new jobs. We are all part of that process. So I think when you look at sort of income inequality and technological change in the 20th century, you see that a lot of that is driven by trade. And I'll mention some of that with kind of back in the olden days, the Sears-Reebok catalog kind of create trade where that creates a lot of value, also creates a lot of disruption for a lot of businesses. So, well, we live in a similar era, but now something else. And of course, throughout 20th century, you see lots of that, right? You see manufacturing moving to China, manufacturing moving to Thailand, to India. Outside of the US, you see many other new jobs emerging. You see winners and losers. But all of that, primarily the interface between countries at that time is through the channel of trade. So today, I think we are entering a new era where not only goods can be moving through state boundaries, but also labor could be moving through state boundaries without us physically moving anywhere. And well, that's That's a new page in the history of the world's economy. And that change is, of course, made possible by wonderful communication technologies and information technologies that are coming online. And overall, I very much agree with Professor Townsend. It's a very positive thing for the mankind in the long run, but again, in the short run, there are winners and there are losers. Wait, how many minutes do I have left?
7.
Okay. So that brings me to kind of the next really important. So obviously right now, kind of this movement of labor where people work remotely, in some ways it's a very new thing. We just started doing it at scale during the pandemic. And of course it was sort of coming for a very long time. And let's see how long ago it started. If you look at most software companies, people at Microsoft, people at Google, people at Facebook and Amazon and Apple, until very recently, nobody worked remotely. So you can say, well, you know, we just discovered remote work was possible very recently. Well, in some ways it's true. In some ways it's completely false. Let's look at one of the most influential software projects of the like 20th century, early 21st century. And I would say that would be development of Linux. Almost all of it was done remotely. And that was many, many years ago. So the possibility of remote work was there, but to a very large extent, it just wasn't work, right? A lot of Linux development was done by developers who were in some ways donating the time, or someone else was donating the time. So the work itself became remote very recently, but in some ways, the possibility of creating software by remote workers was there for more than 20 years. Okay, so moving on. So what does remote work means for sort of inequality, and what does Microsoft do in terms of that? So let me give you a few examples of kind of what we as a company do to create a more inclusive world. And I think that, you know, to a large extent, we can say, well, it's the job of the government to do those things. The job of private corporations is just to profit maximize. And I don't believe that. I think that the large companies like us have social responsibility to make a world a better place. And they are doing a lot of that in various dimensions. Some of them are very local. So, for example, Microsoft contributed $250 million towards creating affordable housing in Seattle, next to our headquarters. That's where we are. That's our home. And we are doing a lot of things to kind of promote more equitable life there. But then there's a bigger question. So what about you know, the world as a whole? Well, we couldn't solve world's problems, but we can do something. And let me give you a few examples that I'm actually really proud of that Microsoft is doing. So first, well, as you know, LinkedIn is part of Microsoft. In fact, my team does a lot of work in collaboration with LinkedIn. And one of the things that LinkedIn does that I think people never talked about, but I think it's really important. One of the things for creating kind of harmonious society is having a society where there is not, where people feel in some ways fulfilled. People don't feel like the anger is amplified. People feel some harmony. And when you go to some social network, you see that they grab engagement by promoting things that get people angry. Well, start using LinkedIn. LinkedIn algorithms deliberately designed to kind of create a very civilized experience at the cost of engagement. And I'm mentioning it here as part of kind of inclusive society, because really I think that's a big part of it. One of the reasons that kind of our governments often couldn't deliver on creating more inclusive societies, because we we are very politically divided in many ways. We need social platforms that would create cohesion rather than division. Here's another wonderful thing that LinkedIn does that probably most of you never heard about. LinkedIn tries to lower digital divide by creating thousands of courses, by partnering with other companies and creating thousands of courses, many of them targeted for people with low skills. And those courses, you can learn anything. You can learn how to video edit. You can learn how to audio edit. You can learn how to do secretarial tasks. You can learn some Python and some basic data science. You can learn a lot of things. And those courses, we are trying to promote those courses. Many of them are very short. They could be half an hour, 4 hours. And they help people to create skills and lower the digital divide, which I think is really, really important. And that brings me to another point about kind of this world without distance, world when remote work is possible. On one hand, this remote work gives opportunities to anywhere in India, in West Virginia, and in California. And yet you see most remote workers live in very affluent areas. And people who in theory have opportunity in areas that may be less developed actually don't get to take advantage of those richer labor markets. Why? Because they lack skills. And that's why kind of we are really trying to partner with both municipal organizations and even with other companies to promote that content that could help human development of people who are lower skilled. So that's one of the things that we do. Let me mention very briefly another thing that I'm very proud of that we do. And that's our work on AI ethics. I myself is a member of the Autor committee that kind of tries to create principles for inclusive AI. And to tell you the truth, early on, when kind of I just got involved in that effort, I thought, well, why should we worry about AI algorithms being fair? After all, if there's any unfairness in the marketplace, as Gary Baker's argument would go, there would be an arbitrage opportunity and the market would arbitrage that away.
One minute.
I don't think it actually works like that. And let me give you one example, just an anecdote that convinced me that we really need to worry about AI algorithms being fair. So one of extremely prominent, extremely smart economic theorists, whose name I'm not going to name here, told me that early on in his career, he had Southern accent. He's white, male, but with Southern accent. And he felt that he was extremely penalized by the job market because of that, because people perceived him as stupid. So he actually made an enormous effort to learn how to speak without Southern accent. And he had a very successful career, and he felt it did wonders for him. Well, now let's go to AI algorithms. Now, when we have hundreds of applications for many, many jobs, and we have more and more reliance on AI algorithms for screening that application, you can have all kinds of biases that could be quite terrible. Let me mention one bias that's relatively innocuous. If you look at AI software that's trained to recognize images, and you look how well it recognizes huskies from wolves, very different animals, but look very similar. Well, it does pretty good. It's about 85% accuracy. So then looking at explainable AI, researchers try to figure out how that does it. So tweak the picture, see what does it. So it turns out that the main feature that the software was using was snow. So the way that it knew that it's a wolf and not a husky is that there was snow in the background. Remove the snow, and it turned out that you train on snow and not on wolves. So think about it. If your software is not explainable, you may end up doing massive amount of discrimination in the labor force, just like my friend with Southern accent was discriminated early on in his career. And the arbitrage wouldn't really be kicking in that strongly, or maybe not at all, because if you're making lower job offers to people because you perceive them being inferior in some way, well, everybody else also makes them lower job offers. So there's not a huge benefit from increasing them. And unless there's a very strong, some kind of performance feedback signal, it can take generations for those kind of inequalities to go away. So I think I'm out of time, but I would like to conclude with paraphrasing the quote from Homer Simpson. Technology, cause of and solution to all life's problems. Thank you.
Thank you, Mike. Sorry, I muted myself. And thank you, Mike, for sharing Microsoft practice and for highlighting the definition of inequalities. Hopefully we can come back to it in panel discussion. So our next speaker is Dr. Chen, who is the president of Luohan Academy. He was the chief strategy officer of Ant Financial Group and was a faculty at Olin Business School, Washington University at St. Louis. Long, take it away.
Thanks, Ginger. You can hear me?
Yes.
Okay, it's my great pleasure to talk about this important and yet little agreed upon issue, the relation between technology and equality. The battle against inequality has become a global theme, but to do that in the right way, we have to understand the basic facts and the logic. So if we look at historically, uneven technology penetration could lead to income inequality. In this graph, you can see the horizontal axis was the daily income, and the vertical is the population. So regardless in 1800, at that time, regardless of different countries with different population, but you can see that kind of the income is kind of somehow even. But then in 1985, 75, you can see that many countries have moved to the right hand. Oh, the vertical axis actually is the poverty line. So back in 1800, a lot of people lived beneath the poverty line. But then in 1975, many more people have moved above the poverty line, and thanks to the Industrial Revolution. Now, so I guess here what we can see is that during the penetration of technology, the lack of opportunity and existence of systematic barrier to technology diffusion are some major culprits for the inequality. The lesson here, though, is that the income divergence accompanying the technology revolutions represents both economic progress as well as challenges to mitigate the transitional pains. So inequality, as many of the previous speakers already discussed, is a dynamic part of economic progress between short-term and long-term. Now, but is there anything special about this round of the technology, the digital technology? So what do we know about the relationship between digital technology and inequality so far? Let's show some evidence. The first thing we notice is that digital technology has this unprecedented speed and scope of penetration. As you can see from the left graph, that it took several decades, many decades, for electricity, telephone, car, dishwasher, air conditioning to have a high kind of a penetration. but then it took the mobile phone only years to do that. Now on the right graph, we can see that this excluding the very low income, then the relation between the mobile subscription and the GDP per capita is kind of vague. So the penetration of the digital technology is not necessarily related to the income levels, and this is very special compared to the previous technological revolutions. Now, another thing is that there's no clear relation between the rise of digitization, AI, and unemployment. On the left-hand panel, starting from the 1990s and in the kind of digital era up to now, even though the world population is increasing, the unemployment rate is kind of steady globally. And on the right panel, there's some countries very higher robot penetration, but some countries have lower, but there's very little relation with the unemployment rate. So probably as the David Autor has mentioned, that there's a lot of augmenting new jobs are coming up. So and anyways, so unemployment rate is not going up yet. And if you look at China, and as many of you know that China has experienced rapid growth of digitization, but as you can see that China's Gini coefficient is kind of stable after the financial crisis, and even dropped a little bit. And in the meantime, the mobile penetration is really going up. And on the right graph, it shows very similar pattern. The IC sector growth has very little relation between the Gini with the Gini coefficient. So, but of course, we have to acknowledge that digital technology has indeed created noticeable mobility and wealth for those who could take advantage of the digital technology in the first place. But overall, I believe from what I can gather, there's very little evidence suggesting that this is to the scale that it becomes a major driver of inequality in more digitized countries. And but we have to acknowledge that some people who can take advantage of technology first, they will benefit faster than some others. As the previous technology, it represents both progress and an issue to address. I guess the goal then is to have the more inclusive digital dividends. So let me talk about this part of this. So because of the more inclusive nature of digital technology, my argument here is that it can be a major driver of equality. And here that we would like to have equality of both opportunities and equality of the outcome, as some of you previously discussed. And I think probably it's important to start with the equality of the opportunities. And there's a lot of public policies wants to push for that. And I think digital technology can play a major role here. So especially from what we observe from practice, digital technology powered business innovations can have major impacts on equality. So let me give you some of the examples. And the first example is the digitized marketplace. It's really a wonderful thing that breaks the traditional boundary of the space and time, that really makes the market become so much bigger. It can reach so many people who could never have the chance to get access. Those are from the consumers as well as from a small business. As we know that traditionally, small business can only serve people maybe within 10 kilometers, but now you can see the average distance between the buyers and sellers on Taobao and Tmall is actually around 1,200 kilometers. Last time when I was sketched this, actually it was around a little bit less than 1,000 kilometers. So you can see that actually the distance is still expanding in the past several years. On the right panel, you can see that there's actually is in the province, in the regions that the poorer, the regions with lower per capita GDP, the consumers buy higher varieties. And that is not surprising. People in the less developed regions, they do not have very good supermarkets. And so they can actually buy a lot of things through the e-commerce to satisfy their needs. And so that is the inclusive, and let's say it's the more equality part of the availability. And to continue, and we can see that it is really a great opportunity for the entrepreneurs. As Mike Spence just mentioned, there's a spur of the entrepreneurship, and especially for the disadvantaged groups and the regions. On the left panel, you can see that it's the gender distribution of the entrepreneurs on Taobao. Now, on Taobao, we know that there's about 10 million companies and startups, and about half of them are women. And we're talking about entrepreneurs. We're not talking about employees. And so on the right panel, you can see that there's the Taobao village, as Erik just mentioned earlier, then that now in the last year, there were 5,425 Taobao villages, and the trading over $1 trillion, which is about $145 billion US. And it also demonstrates a powerful positive feedback loops between skills and training and the other infrastructure that for local development. Now, and this is another interesting for the small business. And if you look at on the right graph here, that is the distribution of the annual income by the education group. And of course, you can see that is the lower red graph represents the higher education. So the horizontal axis is it's the income. As you can see that they do not converge quickly, so and they are more on the right hand side. And the poorer, less educated group, they converge quickly on the left hand side. So you can see the difference of the income. But then this is the amazing part on the distribution of sellers' annual GMV by education group, and they really converge. So really, e-commerce gives them a lot of opportunity for the small business, even for the ones who are less educated. So it gives them really compensate for the lack of the education gap, to fill in the gap. You can see this clearly. And then we can see the second case is the inclusive finance. And so it's not just the accessibility, it's not just about the markets, and also because of the digitized information, now the consumers in the less developed regions, they actually have higher the penetration ratio than the more developed regions of the fintech loans. So they are really and that's thanks for the data, not because of collateral. So I'm going to cite the famous quote from the Ben Holmstrom, that data is the new collateral. And so that benefits people from less developed regions. That's for the consumers. And this is the fascinating picture. Look at this for the small business on the loans. On the left panel, oh my God. So on the left panel is the bank loans. You can see is that it goes up with the income, but on the right hand side is the small business loans. It goes down with the income because it really fill in the affordable technology, fill in the gap here. So the third one is the green transformation, and in my view, that green finance is the least inclusive part of finance, and you can see that. Nowadays, a lot of green finance is really top down, but you can see that for the green transformation, digital technology can do a lot of the stuff. And Craigslist has done a great job, but so is the idle fish in China. Now, this year's trading will exceed 500 billion yuan as GMV, and it's a second-hand goods, and so that is really. When 60% of the users are young people that really enjoy secondhand goods, is a really good example of the circular economy, but without the digital technology to give every secondhand unique goods the digital identification, the trust system is not happening. And then the ant forest I've talked about before. It's very another including interesting example. Since it started back in 2016, it has more than 600 million people subscribed to it. It has more than 300 million trees have been planted. That means several percent of the population are watching their green behavior and growing planting trees every day. So, and
Dr. Chen,
I think
I'm sorry, the time is up, so could you wrap it up? Thank you.
Let me conclude. So historically, technology brings about both economic progress and challenge to inequality. Due to its unprecedented speed and scope of penetration, digital technology by nature is more inclusive and can be used in such a way. So there is ample evidence that digital technology can lead to scalable inclusion, but much more can be done through the combination of digital technology and conscious and smart business and governance design. Thank you.
Thank you, Long. Sorry for the time crunch. Our discussant is Professor Steve Tadelis from Berkeley High School of Business. Steve also have extensive field experience as Senior Director of eBay and VP in Amazon. Steve?
Thank you very much, Ginger, and thank you for inviting me to participate, especially since I'm asked to comment on a topic that I never worked on and do not consider myself an expert by any means. Nonetheless, I think this is a critically important topic to discuss, broadly speaking, the role of business and digital technology in equality or inequality, right? And, recall one of the things that Long mentioned today, and I've heard him discuss this many times, is how digital technology is a much bigger inclusive technology than previous technologies. He showed us the graph on the rapid diffusion of digital technologies. And I think it's quite anticipated, since I believe it follows directly from how relatively cheap these digital technologies are to access and acquire by households compared to other technological advancements, right? If you think of the automobile, right, in the early days, then only the most rich people could afford it. If you think about washing machines, then when they came out, only very rich people could afford it, and so on. Whereas here, you could buy a digital device for very low amount of money, relatively speaking, today. And that, of course, makes it very accessible. We saw the graphs that Hanming Fang presented with the over 4 billion people in the world who have access digitally to a whole variety of digital applications. And I think this also relates to another element of what this digital tech revolution is doing, and that's that it increases the distances of trading. Again, a graph that was in Long Chen's presentation. And I think this relates neatly to one of the observations that Roth made about that AIIB paper on the impact of streetcars in Boston, or the anecdote that he gave about mail-in orders. And that basically, when we think about anything that increases the distance or makes distance commerce cheaper, which obviously digital marketplaces have done in spades, that will typically benefit lower income households relatively more than higher income households, which is another form of equalization. Michael mentioned the trade of labor. I like how he also, used that Linux example of how, this remote work was around for a while. I think COVID really forced us to recognize how available it is. And here's an interesting anecdote. I think many of you may be familiar with a company called Upwork. They are a digital platform for labor, for freelance work. Their stock went up by about 400% during COVID because it became clear that now more and more people are forced to work remotely, and through that forcing realize, hey, this can be done. And this is a point where I think it's worth pausing. I see David Autor on my screen. I'm on my phone, so I have a very small screen. I don't see many people. And I'm thinking about his observation about the nature of how, the types of jobs change, and they continue to change. right? And when I look at these observations, right, that increasing the distance or reducing the cost of distance trading helps equalize, that remote access helps equalize, that access to education that Michael mentioned, another form helps equalize. I think about the anecdotes that Al Roth made, the facts that Hanming made. This is just more of things that we've seen in the past, right? And I think this is yet another example of why my most famous quote is not necessarily the quote of Atkinson that Long mentioned about how one needs to look at equality of outcomes if one cares about equalities of opportunities. My favorite quote is Ecclesiastes chapter 1, verse 9, which says, all that has been will be, all that has been done will be done. There is nothing new under the sun. The kind of patterns we are seeing here are not new. The technology is new, just like every few generations we have major technological breakthroughs, but we tend to see similar patterns. And this is where I want to hit at a point that I think was a little less emphasized by Michael in his discussion, and was more in part of the conversations we had by email before today's conference. And that is whether the haves, the historical haves, may be better capable of taking advantage of these new opportunities than the have-nots. Or the way an economist might put this, could it be that there are complementarities between this pre-tech revolution capabilities and tech itself? And again, this relates to something that Hanming Fang mentioned, where he presented the pre and post-market distributions. Well, we could think similarly of pre and post-digital technology diffusion. So could it be that the children of all the people here on this call are in a much better position to take advantage of these digital technologies than the children of folks who do not have the level of education, exposure, and means, even though they could adopt the technology itself? And I think this is something that I don't have enough information on. I'm wondering if others are familiar with any studies that show that there are these strong complementarities, so that on one hand, we have a technology that at the heart is able to create more equalization, but maybe because of past trends, past path dependence, it actually does not decrease inequality and maybe even exacerbates it. Now, from some of the facts that Chen provided, especially on financial access to loans, maybe that's not the case. But again, I'm wondering about the global versus local. So could it be that what's happening now is that people, say in India or China or other developing countries, that are the children of those parents who are more savvy, more educated, they're going to be the ones who take advantage of these remote technologies, compared to, say, in comparison to the United States, local communities that are disadvantaged in the United States will now not only fall further behind the more advantaged communities, but they will also start being taken over by remote communities in other countries that have the means, the access, and the kind of parenting and drive that will help them take advantage of these digital technologies. So with the opportunities, obviously come also challenges. And I want to close, and I'm not going to spend probably my whole time, then again, most famous words by anyone who went over, but I need to run to class soon. So we talked about the role a little bit of government, right, and of potentially business. I very much liked what Michael said about how large businesses have a responsibility to do more than just maximize profits. And we see that large business owners or retired business owners like Bill Gates or Warren Buffett take this to heart and quite seriously. And I'm wondering, how do we solve this challenge of access, of equal opportunity, of leveling the playing field. Michael mentioned an example of how Microsoft creates access to information, to teaching materials, which is another amazing invent of the digital technology. You think of the Khan Academy, which is just amazingly useful for many children. And this is where I think there is a lot more room for private-public partnerships. Now, I'm familiar with private-public partnerships in the area of government procurement, an area that I used to study over a decade ago, before I made the transition to studying e-commerce and tech. And I know that they have been great successes in procurement of large infrastructure projects. The question is, how could these be implemented towards helping level the playing field and making smart use of digital technology, right? If we think of another thing that David Autor mentioned, of how institutions and demand are going to shape the types of jobs that we'll have in the future. Institutions and demand, but maybe more institutions, will shape the way we have access and diffusion of these digital technologies. And I have a lot more trust in well-architectured private-public or public-private partnerships than I do in government alone, for a variety of reasons. Maybe the two most important is the government has limited access to the talent pool. Most people who graduate from top universities, their dream jobs are not working in government, at least not in the United States, and I think in many other countries as well. And also at the same time, I worry about the influence of politics and populism, right? Since I was a teenager, I always said, tell me how close you are to politics so I know how far away to be from you. So these are things that concern me about governments alone playing the role of regulation and other aspects of helping level the playing field. So I very much would like any references that people have to the success of PPPs, of public-private partnerships, beyond procurement, because personally, without yet many facts to support it, I do believe that that is a very promising path forward. And with that, I'll conclude, so I have 3 minutes to listen to anything else before I have to run to class. Thank you.
Thank you, Steve, for excellent discussion that connects to many speakers' points in this dialogue. So this is a great segue to our open discussion. We have probably 5 minutes for open discussion. So maybe we can start with whether any people have comments on the previous presentations by various speakers. That could include other speakers to others, like one speaker to other speakers' comments and suggestions. Well, if nobody raised the hand, David?
Yeah, I guess I want to inject a little bit a note of caution in our optimism about how technology is just going to make everything better. I think it creates those possibilities, but we can see, all around us many damaging downsides, including the use of AI by authoritarian governments for societal control and filtering of information. We can see the havoc that's being created by social media and the sort of fact that, truth becomes less and less clear, even though information is more and more available. We can certainly see the rapid elimination of many jobs that provide a livelihood for people with middle and low skills, and we I don't think it's I think we should view it as a basic ingredient, or that we can shape, but we should not take it as given that it's going to do what we want to just because we create it, and even who's creating it affects which things we're going to see. And I don't, I like the people who work for tech companies very much, and I like their products, but I do not view them as benevolent. They're profit maximizing, and there's no reason to think that profit maximization is equivalent to social welfare maximization when we're talking about things that have huge externalities and non-rivalrous nature. So I think it's just too convenient to say this is all going to work out well, just go, 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 rather than think more carefully about, what the consequences will be and also what technologies we're focusing on, with some foresight into what they might be doing. So I just want to inject that note of caution. Thanks.
Thank you, David. Ralph Johnson.
I want to applaud this entire forum. I see a pendulum living in what we might call post-Trumpian American politics. People are terrified of all of the things we might call disruptors: technology, climate, finance, globalization, and the ability of government to function. And many, and possibly in the event that things are not handled well, the induced disruption called migration, which tends to frighten people, even though there's great potential in learning across cultures. But I see you pointing to a potential North Star, and I was very interested in Dr. Tadelis' last comments about PPP, because the anxiety in America on the left now is that government is so captured that we can't, what you might call, create a trajectory, a design for the common good and bring these potentials to fruition. I think there's also a lot of what you might call demonization in the United States. China and Mexico experience a great deal of blame for things that really have more to do with our internal processes than with the potentials of technology, international trade, and what have you. So I'm very excited because the fear is so pervasive, to be here for a day and see a combination of the potential and the awareness that the cross currents between social cohesion and these economic potentials through technology are on the same table, and that the questions, as Dr. Tadelis spoke of, about governance, about the quality of governance, is at the core of this challenge. And I would say at the Institute for New Economic Thinking, what we would say right now is the one thing we cannot afford is to pretend that economics and politics are separate domains. Because if we ignore the social consequences of the nature of the future of work, we will experience a harsh and potentially authoritarian politics. And I think that's a danger that can, which you might call, overwhelm many of the benefits from the kind of potential that's been exhibited here. Thanks.
Thank you, Dr. Johnson. Erik Brown-Jefferson.
Well, first off, thanks so much for organizing this amazing event. What a all-star lineup, and I learned so much from listening into it. And I do draw some optimism from just the technology that brought us all together and the clear opportunity to create enormous productivity. But I want to just underscore and bring maybe together the things that Rob and David just highlighted about how that as technology becomes so much more powerful and is able to do so much more good, it also, we have to pay much more attention to its social consequences, and it's not inevitable that they all turn out good. The one that, in the limited time I have right now, just that I would underscore is the potential for increased concentration of economic power and political power, and those obviously often go together. And as technology makes it possible to centralize a lot of data, a lot of knowledge, and move it in a way that wasn't possible in a pre-digital era, it also creates the potential for a small group of people to have a lot more economic and political power than before. And one of the agendas I think we should be thinking about is, to the extent that we want to have shared prosperity and we want to have a lot of people have a say in how things are run and governed, we should think about how these technologies can not only create wealth, but also create or maintain some shared level of economic and political power.
Thank you, Erik. In the interest of time, let's welcome Dr. Tom Sargent to give us some conclusive remarks.
Okay, so you can see me?
Yes.
Okay, so I'm a macroeconomist. So I'm gonna just make a few observations and historical remarks. So what are kind of the classic questions about macroeconomics and inequality generally? So kind of two, what should the fiscal authorities do? And what should the monetary authorities do about the aggregate level and inequality? Those are classic questions. And the two, I would say, polar schools of that both came from Yale. So James Tobin and Irving Fisher, a couple generations earlier. And what James Tobin said was that macroeconomics and the answers to the questions that I just said completely abstracted from should completely abstract from distribution effects. Inequality is off the table when you talk about those two. And he reasoned in terms of representative firm models, representative agent models, and aggregate models. And kind of why did he do that? And it wasn't mostly a theoretical prejudice. It was based on observations that Burns and Mitchell and other people had collected, that if you look at data, a bunch of data, and Tobin looked at a lot of a bunch of individuals, what you'll see is lots of stuff averages out. And what Burns and Mitchell found is that kind of one thing didn't average out, and that was an aggregate factor which governed the business cycle and aggregate growth. And kind of every individual had a loading on those things. And the way Tobin said it was a rising tide lifts all boats. So this was kind of, this was very influential. Down to this day, it influenced the work of Solow. It's in the new Keynesian model, which is all about representative agents, and distributions not talked about, following Tobin's advice. Well, there was another Yale tradition, and that's Irving Fisher. And he thought macroeconomics was closely tied to distribution, and he was very influential. And he was very concerned about how fiscal and monetary policy affected redistribution between creditors and debtors, and how price level fluctuations or aggregate price level fluctuations in the kind of economies we have redistributed between creditors and debtors. And so when the Fed affects interest rates, there's winners and losers all the time. So there's been a resurgence. I mean, they don't cite Fisher, but it's the same thing. There's kind of heterogeneous agent new Keynesian models, where once you put heterogeneous agent models on the table and you solve optimal policy questions, this isn't political economy, it's optimal policy questions with economies with frictions. In heterogeneous agent new Keynesian models, what you find is distribution is pervasive all the time. So so kind of what's the evidence? Was Tobin right or was Fisher right? That's a first order question in modern macro. My favorite paper about that's purely empirical. It's by Min-Soo Chang, Jiahong Chen, and Frank Schwarz. It's a new paper called Heterogeneity and Aggregate Fluctuation, where they use Jiahong Chen like method, very powerful methods to let the data speak about this as well as it can. I'll let you see what their answer is. It's pretty interesting. And then the final thing is, in terms of what should the Fed do, and modern Ramsey problems. So So monetary and fiscal policy, they're not really distinct. They're the same thing because there's a budget constraint. So if you're really concerned about redistribution, which you would be in any heterogeneous agent model where you wrote down a Pareto problem with a planner, a key thing is if you want to redistribute, you have to have policies that are functions of things. And here's where, and one thing you might want to redistribute is wealth, as defined, by earlier speakers, financial plus human wealth. You might want to tax and transfer that, but it's very hard to measure. And now we come back to Irving Fisher, and I think this is modern data analysis. What's the best measure of wealth? Well, first, it's very hard. Larry Summers and various people have pointed out it's very hard to measure wealth and have a wealth tax. But you could say, go back to Irving Fisher, say, what's the best measure of wealth? Consumption. If you measure consumption properly, wealthier people consume more. And so, and having taxes on consumption, the Europeans are ahead of America on this, having sophisticated taxes on consumption supplemented with a redistribution scheme. It's kind of what some cutting edge modern, work, McGrattan and Daria are doing some work on this, but other people too. So, and I'll just conclude with, there's some, Steve Tadelis to say he doesn't like politics, but, so consumption tax, a carbon tax is part of a consumption tax. There's some Democratic senators now who are trying to put that in today. And they say it's a very hard sell. And I'll just close with that. I'm not a salesman, terrible salesman. It seems to me that one of the difficulties of selling a carbon tax or a consumption tax is it's not explained well. So George Shultz and a bunch of economists had last year before he died, they recommended a carbon tax accompanied as a package, accompanied with a redistribution that completely took care of the redistribution. It's a carbon tax linked with a transfer. So I think people have to start selling not just the tax, part of the tax, it's all generally equal, sell the whole package. And, more optimal tax systems are going to, that are going to have the consumption. I've talked too long. That's all I have to say.
Thank you, Dr. Sargent. As a Nobel laureate in macroeconomics, your historical perspective is really refreshing for today's debate on technology and equality. I hope all of us will continue thinking about this important topic and have a collective influence as economists on future public policy, private operations, and probably public-private partnership. So this would officially conclude today's dialogue. I hope to see you all in the next event. Thank you.
Thank you very much.
Thank you.